In today's episode of the MSA Rental Market Update, we are looking at Richmond, Virginia rental market for multifamily properties. So the Richmond metro statistical area, as you can see, is outlined here by CoStar. You can see where it is in relation to the central East Coast. We have New Jersey, Philadelphia, got New York City up here, Washington, D.C., Baltimore area here, Norfolk and Virginia Beach here. Raleigh-Durham area, Charlotte, North Carolina, and then all the way up here we got Cincinnati and Columbus. Here's Pittsburgh. Kind of gives you an idea where on the map the Richmond metro statistical area is located. So let's go into our filters and see what we are excluding. And as usual, like we've done with every video to this point, we're excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable so that we are looking only at conventional apartments. When we look at location, we can see that we are in market, metro statistical area, Richmond, Virginia. So let's go take a look at the analytics and see what all three asset classes combined are telling us. So here is the supply snapshot for the Richmond metro statistical area. There are 1,314 conventional apartments in this market, totaling 100,205 units. There are 6,697 units still under construction. And in the last 12 months, 19 more vacancies occurred than people renting apartments. In the previous 12 months, 4,058 more people rented apartments than went vacant. Big change. We can see that in the vacancy, where the vacancy has increased 2.5% from 5.3 to 7.8. We are still showing a 3.3% year-over-year rent growth, but we'll see what it looks like quarter over quarter. As usual, we do not look at the capital markets. We only look at the space market. So if we come down, we can see the long-term occupancy average. And over the last 22 years, the market likes to be at about 93.5%, and it is currently sitting around 92%. So below that long-term occupancy average, with negative absorption, properties under construction, slowing rent trends, vacancy increasing, we are probably sitting below that long-term occupancy average in the recession phase. But when we get to the end of this video, we will verify where it is, and I will plot this on our market cycle chart as I see it today. So let's take a look at the data for all three asset classes combined. So here is the data analytics for the Richmond metro statistical area. We do not look at asking rent. We only look at effective rent. In the first quarter of 2022, it was at $13.88, went up to $14.18, very slightly down, probably considered stabilized to $14.17, then down to $13.91. And in January of 2023, we did go up, looks like 20 cents or $20 per unit to $14.11. So that's interesting. We'll see what our deliveries and absorption tell us and see if that was warranted or if it just went up because people felt like raising rents. Who knows why people do things. And being as low as we are in vacancy, there should not have been a reason to increase that, but we'll take a look and see. So we are sitting at 682 units delivered and only 417 absorbed in the first quarter. So lacking there, I like to see 80% or more. Then 570 more delivered, only 164 absorbed. And you can see the occupancy is going down because of it. And then 809 delivered, and then another 124 go vacant. 72 more deliver, another 466 go vacant. Another 1,011 deliver. So you're looking at what? 1,500, 1,600, 2,400, let's just call it 2,500 units in the last two quarters, including the month of January in the third quarter, and a whopping 268 units totally absorbed during that time. So not really a pretty good tale that it's telling us here. We definitely have gone down in occupancy. We can see fourth quarter of 2021, we were at 94.8, and now it's sitting at 92.2. So it has been steadily going down every single quarter. Looks like really it peaked around the third quarter of 2023 and has steadily been going down ever since. So this kind of puts a confirmation on the recession part of this phase, even though we had that slight uptick in January. I don't think it can sustain because it is not keeping up with these deliveries. We'll see how it goes the rest of the quarter. But let's go see what each individual asset class is telling us. So let's go look at the A's first. Here is our Class A rent analytic data. There are 125 properties totaling 22,661 units. Looking at effective rent, we started at $16.11, went up to $16.65, went up to $16.69, down to $16.43, and then for the first month of 2023, went up to $16.50. Okay, so a little bit of a roller coaster in the last 2 quarters with that 1 month trend going up. We'll see if that trend stays that way for the remainder of the quarter. My guess is no, with what's going on with inflation and interest rates right now. So I'm going to expect to see this number probably come down quite a bit when we show the full quarter's data. But for the month of January, it did tick up slightly. So if we look at our deliveries and absorption, we've got 672 delivered in the first quarter, 689 absorbed. So good, strong absorption. 320 delivered, 762 absorb. Again, very good, strong absorption. 788, 649. I like the absorption. It explains why the rents held strong through the first 3 quarters. Then only 72 units deliver in the fourth quarter, but then another 20 went vacant. Then 1,011 deliver and 476 absorb out of that 1,011. So little bit of a different tale here coming in. We had that downtick in rents and then an uptick here, even though we went down in occupancy. So that's a little strange that we had that big of a dip in occupancy and still had that uptick in rent. Again, very early on. I know it's only 1 month worth of data. CoStar says it's accurate at this point, but we have to take CoStar's word for what it is, and we all know what that means. So, should have been a decline in rent. The rest of the market is acting appropriately except for this first month. So, I'm going to probably guess we're going to see an adjustment in this first month of 2023 as we move forward, because occupancy declining like this is going to show those rents declining as well. All right, so that's Class A. Let's go take a look and see what story the Bs are telling us. Here is our Class B rent analytic data. There are 395 properties totaling 36,211 units. Looking at effective rent, we were at $14.46 in the first quarter, up to $14.63 in the second, slightly down to $14.61 in the third, down to $14.28 in the fourth, and up to $14.61 in the first month. Let's see if occupancy holds true here, or if we're continuing this monthly uptrend even though occupancy is declining. And as we can see with absorption, that's exactly what's happening. We are 4 straight quarters of negative absorption. So these are 10 units delivered vacant, another 114 go vacant, another 250 delivered vacant, another 281 go vacant, another 21 delivered vacant, another 274 go vacant, another 70 goes vacant, and another 70 goes vacant. And even though we've had this negative absorption trend, we show an uptick in those rents. So I can't explain that other than it could be erroneous data by CoStar, or it could have been the owners, because there was this feel good that inflation may have been captured, and it looked like interest rates potentially could have been driven down by the Fed, which I think is junk. I don't believe that. Do not believe that, if that's what you are thinking. The Fed is not going to drive these interest rates down even when it captures inflation. They are going to step back, and the market is going to put our interest rates where they belong, which will be on the long-term average at that point, somewhere between 6 and 8%. You can mark my words, I will be absolutely shocked if after we've captured inflation, if interest rates go below 6%. Until the next major economic event occurs, the Fed will have no reason to drive the interest rates any lower than that. It's going to let the market do what the market does. Just my opinion, but that's not why we're here. trying to explain why we have all this negative absorption and an increase in rents. That's why I'm trying to, but who knows? Owners do what owners do, managers do what managers do. All I can tell you is that demand supply fundamentals say we should have seen negative rents coming into this first month, but we did not. We saw an increase. So I'm just right now going to call that erroneous information at this point. Okay. So the B's are telling us a little bit sadder of a story. Let's see what the C's are telling us. So here is our Class C rent analytic data. We have 660 properties totaling 40,163 units. Looking at effective rent, we started the year at $1,178, went up to $1,203, very slightly down to $1,200, down to $1,181, and then again up, as with all the rest of them. The C's went up in the first month. Now, I'm really not trusting this data because I'm going to wager a guess that, and I have not seen the data, that absorption is going to be negative in all 4 quarters of 2024 or 2023, again, of 2022. So let's go see. As I suspected, negative and big negative absorption, believe it or not, here. So there is absolutely no reason, especially with occupancy down to below 93%. That's a 7% vacancy. About that point is when owners start to lower their rents because they don't want to go below that point. They call it the danger zone because you start to get below 93%. You're getting too close to that 90%, which will eliminate, when you go below that, agency debt if you go to sell this asset. So the fact we had an uptick again in all 3 asset classes, absorption negative in the first month of B's and C's, and only a very small percentage absorbed in the A's. I'm just going to call the first month of January in Richmond, Virginia, erroneous data. So we're going to discount it altogether. The rest of the market seemed to have been doing appropriately. It begs to tell you here that they should have gone negative rents faster quarter over quarter, but if you look, our occupancy was still pretty high. We didn't hit that 93% point until fourth quarter. So I'm going to give the ownership the benefit of the doubt here and say they were trying to hold off as long as they could. But once they got below that 94% towards 93, they lowered those rents, and that's doing what you're supposed to do. So other than the month of January, I'd call the Class C's reacting appropriately because of the high occupancies. But moving forward, I think we're going to see these trends go down. It's going to be interesting in the next couple of weeks to see what the January's numbers show us then, because even though CoStar says this is good data, it just doesn't look like good data. It's not giving us appropriate information. And with the other quarters reacting appropriately, I'm just going to call it bad data. Okay? So what does that mean for this market? Well, we were 1.5% below the long-term occupancy average. We're in negative absorption in 2 of the 3 asset classes in all 4 quarters of 2022, and very slowing absorption in the fourth quarter. Just the fourth quarter of the Class A's. Got to pull that memory bank out there. So that said, because the rents are declining, even with that little bit of an uptick we saw, I would put the Richmond market right here on this point in the recession phase. Even though we had that year-over-year number, I think as we get into the first quarter and we see the full first quarter data for Richmond, I think we're going to see a negative rent year-over-year, which would definitely put us in the recession phase. But because of absorption going negative, because of quarter-over-quarter rent declines, being 1.5% below that long-term occupancy average, I am comfortable placing Richmond on the first point entering the recession phase. Okay? So that does it for Richmond, Virginia, or the Richmond MSA rental market. Stay tuned tomorrow as we take a look at Greenville, South Carolina, and then we'll finish the week out on Friday with Fort Myers, Florida. I will see you guys tomorrow.